It doesn't sound like much, just $10 a day. That's less than a meal, less than most impulse purchases. But what if that small daily investment could completely change your financial future? Most people underestimate how powerful consistency and compounding really are. In this video, we're breaking down what actually happens when you invest just $10 a day, how it grows over time, what kind of returns you could expect, and why starting small might be the smartest financial move you ever make. The power of small, consistent investing. Most people think investing is only for people who have thousands of dollars sitting around. That's one of the biggest financial myths out there. The truth is, investing $10 a day means you're putting in $300 a month. That's it. And while $300 might not sound like a life-changing amount, it's not just about the money you put in, it's about what that money does while it sits there. When you invest consistently, your money earns returns, and then those returns start earning returns too. This is called compound interest, and it is the single most powerful force in personal finance. The longer your money stays invested, the more it multiplies on its own without you doing anything extra. The key word here is consistency. It's not about timing the market or picking the perfect stock. It's about showing up every single month with that $300 and letting time do the heavy lifting for you. What $10 a day looks like after 10, 20, and 30 years. Let's talk real numbers, because this is where things get interesting. If you invest $300 a month starting today, and your investments grow at an average annual return of 10%, which is close to the historical average of the S&P 500, here is what your money looks like over time. After 10 years, you would have invested $36,000 of your own money, but your total account value? Around $61,000. That's nearly $25,000 in growth you didn't have to work for. After 20 years, you've put in $72,000, but your account has grown to approximately $204,000. You didn't work for that extra $132,000, your money did. Now, after 30 years, your total contributions are $108,000, but your investment account? It's sitting at around $592,000, close to $600,000 from just $10 a day. And if you stretch it to 35 years, you're looking at over $970,000, almost $1 million. These numbers aren't magic, they're math, and this math works for anyone who starts and stays consistent. Where should you actually put your $10 a day? Now that you know what the numbers look like, the next question is, where do you actually put this money? The good news is, you don't need to be a finance expert to invest wisely. The simplest and most beginner-friendly option is an index fund, specifically one that tracks the S&P 500. Index funds are basically a basket of the 500 largest companies in the United States. When you buy into an index fund, you're not betting on one company, you're betting on the entire American economy. And historically, the American economy has gone up over the long term. Another popular option is ETFs, which stands for exchange-traded funds. They work very similarly to index funds, but can be bought and sold like regular stocks. Platforms like Fidelity, Vanguard, and Charles Schwab offer index funds with very low fees, which is important because high fees eat into your returns over time. If you're outside the US, most countries have their own versions of index funds and low-cost investment platforms you can access easily. The bottom line is, keep it simple, keep fees low, and stay consistent. The role of tax-advantaged accounts. One thing most beginner investors don't pay enough attention to is where they hold their investments. The account type matters just as much as what you invest in. In the United States, there are accounts specifically designed to help your money grow faster by reducing or eliminating taxes. The most popular ones are the Roth IRA and the 401k. With a Roth IRA, you invest money that has already been taxed, and when you withdraw it in retirement, you pay zero taxes on the growth. That means all those gains we talked about, the $500,000 or more, you keep every single cent of it. With a 401k, especially if your employer offers a match, you're essentially getting free money added to your investment every time you contribute. If your company matches even 50% of what you put in, that's an instant 50% return before the market even does anything. If you're not using these accounts, you're leaving real money on the table. The $10 a day strategy works best when it's combined with the right type of account that protects your gains from taxes over the long run. Why most people never start, and how to actually begin. Here's the uncomfortable truth. Most people know they should invest. They've heard about compound interest, they know time in the market matters, but they still don't start. Why? Usually it comes down to three things. They think they don't have enough money, they're afraid of losing money, and they don't know where to begin. Let's address all three. First, $10 a day proves you don't need a lot of money. If $10 a day feels tight, start with $5. The amount matters less than the habit. Second, fear of losing money is real, but it's based on a misunderstanding. Over short periods, markets go up and down. Over long periods of 10, 20, 30 years, the market has always recovered and gone higher. If you're investing for the long term and you're not touching the money, short-term dips don't hurt you. They actually give you a chance to buy more at lower prices. Third, getting started today is easier than ever. Apps like Fidelity, Vanguard, Schwab, or even beginner-friendly platforms make it possible to open an account in under 15 minutes. You can set up automatic investments so the $300 leaves your account every month without you even thinking about it. Automating it removes emotion from the equation, and that's a big deal. The difference between starting at 25 versus 35. One of the most eye-opening things about investing is how much starting age matters. Let's compare two people. Person A starts investing $300 a month at age 25 and stops at age 35, just 10 years of investing. Person B waits until age 35 and invests $300 a month all the way until age 65. That's 30 years of investing. You'd think person B, who invested 3 times as long and put in 3 times as much money, would end up with more. But here's the surprising result. Person A, who invested for 10 years early on, often ends up with more money at retirement than person B, who invested for 30 years but started late. This is the magic of compound interest working over time. Every year you wait to start is a year of compounding you can never get back. The best time to start was yesterday. The second best time is right now. Even if you're in your 40s or 50s, starting today is still massively better than waiting another year. What $10 a day can actually buy you in the future. Let's bring this home with a real-life perspective. After 30 years of investing $300 a month, you're sitting on roughly $590,000. What can you actually do with that? If you follow what's called the 4% rule, a widely used retirement guideline, you can withdraw 4% of your total savings every year without running out of money. 4% of $590,000 is about $23,600 per year, or nearly $2,000 a month. That's money coming in every single month without working for it. Add that on top of any Social Security benefits, a pension, or other income, and you're looking at a genuinely comfortable retirement, all funded by $10 a day. Or maybe you don't wait until retirement. Maybe after 20 years, your account has grown to $200,000 and you use that as a down payment on a rental property that generates passive income. Wealth isn't built overnight, it's built daily. If this changed how you see small investments, hit like and subscribe for more practical money insights. And watch the next video to learn how to choose the right investments for steady long-term growth.